Ladies and gentlemen of the crypto space, we're live on a Friday, March 22nd at 11:01 a.m. Let me see if we are effectively sharing as much as I'd like. I wish I got to check in on X, see if I could reshare a live stream. I don't know. I don't like doing this kind of activity while I'm starting a stream with you guys, but I wouldn't mind getting this message out to more people. It's a very important topic, and I started a little tweet X rant, sheet rant, or whatever the hell they call it, last night, and I think now's the time to really remind folks that of the story, of the core story that I've learned over the last couple of years, and it's more important than ever. It's the undertone, the bass, those subtle uh, components of how financials work that not only the vast majority don't understand, the vast majority think dollars are money and are battling over the terminology, the definition of these words. What is money? What is value? What is currency? And I've been very clear in defining what I define them as because that's how the system works and what I've learned from macroeconomists and what I see in the chart data as well. And it's obvious, it's clear as day. It's not, this is not really analysis, it's literally what the data says is going to play out. The destination is unambiguous. The destination is not just clear as day, it's going to happen because we understand the mechanics. It's the path. The path gives us a bit of uncertainty. There's always uncertainty, but there's very definitive things we could say about the path that's going to occur. The reality of a debt-based system. Debt means if you don't pay, there's capital destruction. If you have collateral and you borrow, there's capital creation. That's really currency creation, dollar creation. So in a debt-based system, the system can collapse at any time. Today, in theory, the whole thing could fall apart today. And there's a threshold in which there's no intervention that could be done to stop it. So everyone is sitting around month after month after month. It's going to collapse. Everything's going to collapse. Not, it could collapse today. So the whole point of my content over the years has been to take all of this shit and all this really bullshit that people talk about, this whole fear of a stock market crash, and not redefine it, but fold it into a story that's digestible so that you could find peace of mind in all of this bullshit activity and behavior that people are trying to figure out. People are like, is it going to go up? Is it going to go down? It's going to go up because the global currency construct is going to significantly increase. It has to because that's the way the system works. The mechanics. The mechanics are bonds are money, money prints currency, dollars are currency. Now, literally, as a reductionist, you can strip out all foreign fiat. As of right now, foreign fiat is the margins. And you can always understand that change starts at the margins, and foreign fiat, things can become interesting. Foreign current countries and their geopolitical goals can become interesting, which means things change over time. Hi, do you want to say hello to the audience? There's 63 people saying hello to my lovely daughter. Young lady, can I work? Thank you. So, oh my God, you didn't see me, she says. That's great. Big, beautiful girl. Um, that change that everyone talks about, the whole brick story, Yeah, fine. Things are changing. Great. How long? It takes time. A long time. A lot longer of a time than anyone could possibly think. Why? Because of the global debt construct. How the money is turned into currency. Because every dollar in existence, you can pretty much say that because it's almost all dollars, has an interest rate payment associated with it. So for any of those currencies to become meaningful, any foreign fiat, any foreign currency, what have you, the debt needs to be repaid because someone owes dollars to someone else. And I don't care if another currency is getting popular, if someone owes you money, they want to be paid. And they're not going to accept, oh, could you pay me in this other currency? No, you pay me in what you told me you're going to pay me in. Because that person probably has debt and owes dollars. So nothing is going to change in that regard because people will get angry if they don't get repaid in the denomination they want to get repaid in. So the system could collapse at any time. Great. Understand how and why and what they do to manage it. The fact that it's not collapsing today, considering commercial real estate and how debt is used to create currency and how it is sold offshore and how much internationally is owned of the U.S. commercial real estate market and what's going on in China, which is literally in a deflationary state, should indicate to you how much control, how many levers are being pulled to massage the global money and currency construct. It is a managed financial system. There's nothing organic about it. It's managed by central banks, and that was literally the point of the central bank inception. And every damn country has a central bank. To top it all off, every country has a treasury, of course, and every country has a political body that says, hey, treasury and central bank, do your fucking job. Manage this shit. Keep the system working. Now, path. Historically, political optics didn't favor varying degrees of intervention, and there was a lag effect because of the political optics, but also because of the technology and the potential volatility. I mean, the volatility was big in previous events, historic events, 87, go back earlier, 2000, 2008, big volatility, and they don't want to get to that anymore. So the moral hazard's been taken out back and shot. And the political optics, if you combine it with that, it's much more favorable for intervention. I mean, they're literally giving money to student loan borrowers, which they literally don't hesitate for socialist programs anymore. The socialist, it's written all over the wall, and that's the end state for like a CBDC. It's just a pure distribution of capital and capital controls and all these social programs. So there's no inhibition, and the political optics, the state of political optics, very much allows and favors these kinds of behaviors. Maybe we've been conditioned for it. Maybe we've been, as a society, pushed to the point where we not only accept it, but we hope for it. In any case, that's where we are. The United States commercial banking system began to fail in March of 2023. If it was an organic financial construct, the system would have started to fail. Bank runs would have precipitated. It would have gone viral, especially at the speed of social media. Fear would have propagated, and it would have spun out of control. Same thing occurred privately in the repo market in September of 2019. Fear propagates. This is a very interesting chart in that regard. This is the absence of fear, or also fear. On the way up is fear, because considering the global currency construct and how money works around the world, U.S. bonds, that's the pristine collateral. because everyone owes dollars. Everyone owes dollars. Therefore, everyone wants dollars. Therefore, the bonds are everything. So this chart is like peering through the bullshit. This is the baseline of the global soundtrack. And this chart is saying something extraordinary, not only if it continues its directionality, but merely where we've gotten to. It pushed right through the 3-month time weighted average price, and that's the long term. That is a high time frame time weighted average price. Shorter time frames give you a more focused perspective on what's going on today. But the longer you go out, it's telling you something about not just today, it's telling you something about where we're heading and the short to midterm future. This is a forward-looking indicator of the state of global money, not currency. We don't spend money on the planet. We spend currency. Money is used to create currency. And I've discussed the erroneous takes that the general public have about the United States government in regards to money printing. It's generally wrong. Yes, the whole money printer go burr thing from the Fed is just not the way it works. The vast majority of dollars are not printed by the U.S. government. The vast majority of dollars are printed not in the United States. They're printed outside the United States. The whole point of this story, and I'm going to continue telling it like the foundation of the story, is because this chart is screaming something is absolutely massive coming this year, maybe heading into next year, and at some point that party ends. But right now, it's imperative to understand that bonds are money, and that money prints the currency. So why is that so important to accept? As this chart rolls over, the volatility of the price of the money is collapsing, which means if you have an account of $1,000 worth of Ethereum, and for the next 3 months, let's say, it's sitting at $1,000 worth of Ethereum, what do you want to do with that Ethereum? You're probably thinking to yourself, maybe I put it in an LP position. Maybe I throw in an Aave and borrow a couple $100. Maybe I throw it on Curve and borrow a couple $100 worth of CRV USD. Because the Llama says, even if it gets volatile, the Ethereum price gets volatile, I'm protected to a degree. Risk. Risk to protect the value of your underlying money. If anything, Ethereum and those types of collateral assets are a whole conversation about that we could have, but has a property of money, has a moneyness property. And in the global financial system, that's bonds. So if your money is relatively stable in price for a period of time, it gets itchy and hungry, and you want to put it to work because you feel like you're underperforming or you could do something more with it. You're staring at a chart indicating how many trillions of dollars are starting to get itchy. Think about that. And then there's other factors that are going to occur in 2024 that really indicate, to me especially, that shit's going to get weird. If the money's getting itchy and the risk is peeling off the onion and it's diminishing, there goes the leverage. Your Aave health factor just went from 2 to 4. Going to bump the leverage. And when you say the phrase bump the leverage of the global financial construct, it's at a degree that's extraordinary because you're not talking about borrowing $500 on $1,000. You're talking about taking $1 trillion and borrowing a half $1 trillion, or $10 trillion and borrowing $5 trillion. Big numbers. So fast forward a couple of years post 2020, and if this cycle continues, I mean, you're talking about like 28, 32, it's another story. But we're talking about this cycle. And I think in terms, you could really always, the horizon is about, sub 4 years. And it's been repeating, and that's the story Raoul Pal talks about. So we printed a lot of treasuries in 2020. The Fed monetized a bunch of it, which is basically the Fed creating currency units, spending them into existence to purchase those treasuries. So that's how their balance sheet became in its current state. And that contributes to the global currency construct. So all those treasuries that were printed, all that money that was printed, money, not currency necessarily, in 2020 has a refinancing period. And it turns out that refinancing period was about 3 to 5 years. So it folded into the $34 trillion worth of U.S. debt, which we're sitting at, which has an average refinancing period of 3 to 5 years. So in 2024, this year, they have to refinance $10.8 trillion. At least Claude AI has come up with that number, which factors in the amount of debt they issued in 2020, which factors in the historic debt construct, the historic money construct of the United States. Now, which is more potent? Money or treasuries that have been issued a long time ago and have circulated throughout the global financial system and have been bought, resold, rehypothecated tenfold over, 20-fold over, and how much more leverage can you squeeze out of them? How much more juice can you squeeze out of the lemon? They become less bang for the buck and less useful. In 2024, $10.8 trillion need to come out of the United States Treasury to pay $10.8 trillion to existing actors that have these debt instruments. They have to send out $10.8 trillion to pay off debt, which now means the 10 to 1, 50 to 1 dollars that were printed using that debt now have dollars at the base that have been de-risked. So that is part of the equation. The other part of the equation is when they're raising that $10.8 trillion and de-risking the system, there's now $10.8 trillion worth of fresh, as it's called, on-the-run treasuries coming out of Treasury, fresh on-the-run collateral that's coming out of the Treasury Department into a collapsing Treasury volatility environment. $10.8 trillion plus fiscal year 2024 deficit spending, which, rough calculation in earlier posts by me, tweets by me, it's about $13.9 trillion going to come out of Treasury this year at the run rate of 2024 thus far, deficit spending. $13.9 trillion is bigger than 2020. It is a massive, massive amount of money. Now we look for the conditions for that money to be turned into currency. And that's where, when you understand the way this structure works, it's like, oh shit. If $13.9 trillion of fresh, unrehypothecated money is going to be coming out of the Treasury Department, what you want is a condition of low volatility. And that's the precursor to the international dollar printing process. And it just so happens that the move indicator is rolling over. What do we know about momentum? Momentum carries. If it's rolling over, it's going to continue to roll over until it capitulates. Trends continue until capitulation. As always, the chart will tell us the truth. The chart tells us what it's doing. If you see some shit blow up, the move indicator is going to spike. Bond yields will spike. And there'll be a sell-off. Why? Because that's the mechanics. If you need dollars, you sell whatever the hell you have. So they sell their bonds, and That's the Lou Groman story, where the world has how many trillions of dollars in their piggy bank that they could sell to raise dollars into a relatively thin dollar FX market, which is exactly maybe why Japan's in a bit of a pickle. So this is not something I necessarily fear this chart as much as it's blowing out, and it looks like it could potentially blow out. It's a managed global currency construct, and I don't think they would have come out with those statements that they're going to turn off yield curve control if they didn't have a plan. And now everyone could say, oh yeah, they're in great control. I would say yes, they're in great control because today, as of right now, the global financial system isn't collapsing, which means they're in control, which means they have these plans and they have these processes and structures and facilities and strategies and expectations. It is a completely managed system. Every second of every day, they are pulling levers. So yes, they are in control, especially considering the move indicators. So you think if you have a trillion or a couple $1 trillion worth of bonds, you have, the little red phone in the corner of your office to call up persons that know what's coming down the pipe, what plans are in place to manage your risk. You have your connections. So the move indicator is that the bond volatility, well, obviously the bond yields and looking at the bond market, the bids and ask and how much activity is occurring is ultimately the source of truth. But the move indicator is a very simple indicator that is an expression of that buy and sell activity. So it gives you a nice chart about what the hell is going on in that market that the guy with the little red phone in the corner of the office is very interested in because he has a lot of money sitting around and he wants to make money. So he's very curious about the volatility of the bond market because he wants to lever that shit up. So if 10.8 trillion plus fiscal deficit spending, $13.9 trillion is coming out of Treasury in 2024, and the bond volatility continues to collapse, if it continues to collapse, and the chart tells us that, not that tomorrow it spikes, yeah, that means some shit's going down, and it could fail today. Whole global currency construct could fail today, and we'll see it in the data. But this data, if it continues down, indicates optimal conditions for turning money into dollars. Now, what's different this time? I didn't even get to the good part. I didn't even get to the good part. You got ahead of me and started thinking, and I didn't even get to the good part yet. Interest rates. Interest rates. Interest rates are at the highest level in decades. So what are interest rates? Interest rates are incentives. They create flows, cash flows. So if you are a lender and you can charge a higher interest rate, you're going to make money because someone's going to pay you. Now, in 2020, they printed all that money out of Treasury, money, bonds, and it was used to create currency at basically a 0% interest rate, a couple of basis points. It's nothing. That was the incentive. A little bit of bullshit flow at the bottom. Now that interest rate is whole percentage points. There's going to be flows to be had. Now, all of those bankers around the world have the potential to make massive, 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 monumental, mind-blowing bonuses because they have a product that they can sell that's going to earn them whole percentage points. Multiple whole percentage points. If you could sell something and get 5% on the money versus sell something to get a quarter of a percent, 0.25%, you're going to have a much greater incentive to sell shit at 5% because you're going to get a whole lot of cash flow. So we're heading into an environment where the greatest amount of money in history is being introduced into the global financial system this year, into an environment where the greatest incentive setup exists in the last couple of decades Holy crap. It's quite interesting. So bond markets leverage. Everyone leverages. So what, 10 to 1, 50 to 1? Bonds, they leverage. So if $13.9 trillion is being issued by Treasury, that money is leveraged at 10 to 1, that's $139 trillion. And 10 to 1 seems conservative. Let's say greater than that. Let's say 50 to 1. So between 139 and what, 500 and something, whatever, 600? Let's say between 140 and 600 trillion dollars is going to be added to the global financial dollar system between this year and next year. That's a lot of dollars. That's a lot of currency. And when you're talking about markets, you're talking about flows, delta in currency, and that moves price. Positive sum environment, negative sum environment. So if you have all that currency that is going to be seeking out opportunity, it's going to drive asset prices significantly. You buy shit, you invest, you own. Um, and then we get into like cross-border flows and which markets are going to be interesting. And I think emerging markets are going to be very interesting. Sovereign nation-state emerging markets, and it just so happens that these crypto emerging markets are going to be much more interesting because they're much smaller, much smaller, and these are very interesting businesses that are going to become increasingly looked at as businesses, not just stupid meme coins. We're talking about businesses. And what are businesses? Credit, foreign exchange, derivative products. And that if you're talking about a global financial system, everyone in that world is like, oh shit, these are very interesting credit, foreign exchange, and derivative products. So the potential for flows is extraordinary into this relatively microscopic set of emerging markets. There's a little bit less than $150 billion in these emerging markets, with 140 to 600 trillion dollars that looks like is going to flood the global currency system. So we look for what conditions are going to create that flood of currency. And it's all set for this year. Now, interest rates are an interesting one. Why do you think they don't want to cut interest rates? They don't want to cut interest rates because they know they got to juice the global currency system to encourage expansion, interrupt deflation. Deflation is the depth of a global currency system. So we're going to have the great expansion. This is going to be a monumental, mind-boggling expansion. And yeah, you could get into conversation like next cycle and the cycle after it gets bigger and bigger, and then you get into those Weimar hyper-cyclical gold charts. That's another story. And where consumer price inflation lands versus asset price inflation, it's a complicated set of mechanics to digest, and you really have to talk about everything specifically, granularly, and break that shit down. I think they're going to try and avoid cutting rates. Now that has double edges. If you avoid cutting rates, you got the U.S. domestic banking system, which is all upside down, inverted curves and whatnot, which means the banks are in a shitty situation for making money because they make money by borrowing short and lending long, borrowing at a cheaper rate and lending at a higher rate. They make the money on the spread. So their businesses are all fucked up. And the only thing that can fix that is the lowering of rates, which also happens to cure their balance sheet impairment by increasing the price of collateral. But if you lower rates, you're taking the incentives off of the global currency printer. So that ultimately is part of the indicator that says the party's starting to end. So when they start to lower rates, it's the complete opposite of what the general public talks about. The lowering of rates is the end of the cycle. We just described what the cycle is. The cycle has nothing to do with quantitative easing. Cycle has nothing to do with the cutting of interest rates. You're late. You are late if you're looking at those indicators. That's them trying to massage the system to maybe fix things. Like if the banks start to spiral, that's why they historically cut rates to juice their balance sheet so that they have more money and they could sell their collateral to raise capital or to borrow capital and pay exiting deposits. Don't look for the cutting of the rates. If we get to the end of 2024 and they don't cut rates at all, holy crap. Higher rates, higher incentives for the global currency printer. The crazier the crypto markets are going to be. We could simplify the conversation and say the emerging market I look at is the crypto markets because these are the markets that are going to run multiples. 140 to 600 trillion dollars floods the global currency system by the end of 2024, some maybe in the start of 2025. And then when that's occurring, things are frothy as fuck. Super duper duper frothy. And then maybe some shit breaks and they have to start cutting rates, and that'll take the steam right out of the global currency printer. And what happens where after a significant move, after the capitulation, the collateral has now been leveraged, and everyone's in a frenzy, and now they're starting to take profits. The breath runs out. If you move 10, 10, 10, 10, 10, 5, 5, 4, 4, 4, 3, 3, 3, 3, people start to see that topping pattern, and now the sentiment starts to shift. So there's your cycle. We're nowhere near the start of the cycle. Well, we've seen the start of the cycle. And the start of the cycle on this chart, it's taken a good 15 months. 3, 6, 9, 10, 11, 12, 13, 14, 15. 15 is low. 18, 21, 24, 27. This topping pattern has been 27 months. This is a longer topping pattern than back in '08 for bond market volatility. Now, it's manifested very differently. That was a very interesting crisis in '08, and I was very young. But this is a structure that's akin to that. It's taken that long for the volatility in the global money supply to subside. And we're coming into what looks to be a secular change in the structure of the system. After the top in 2008, it was a decade of lower highs and lower lows of bond market volatility. Why? Because they had to respond with more geopolitical controls and coordination and all the shit they do at the central bank level to manage the global financial construct and how it's changing. It's new, it's different. And they have to manage it and they adapt it. And they were able to get the system to continue to expand for a decade. And interest rates were pinned at zero. So interest rates are not the indicator to look at. That's just part of their tool set. You're wasting your time looking at interest rates to understand the global financial system, and there's no magic money printer. There's no magic Federal Reserve Jerome Powell money printer. It doesn't work like that. That's lagging shit. You want forward-looking indicators, and you need to understand how the money works. And the biggest shock that most people should have is that you don't spend money. You don't use money to buy anything. Use currency. Money prints currency. So this is the way it's all going to play out. The path DXY looks pretty complicated, pretty shitty. This is very much real time, but this is very much an expression of geopolitical collusion and them literally working in real time to manage the construct and how well they're managing it. The better they manage it, the more stable this is, and it should trend down. If this is trending down, foreign countries are stable and their capacity to execute business is stable. If this is trending up, foreign countries are under pressure, and it just so happens this is a globalized system still, which will take a long time to slowly deglobalize, and we are completely dependent on imports, especially of uh, uh, the critical minerals, and it'll take decades for the U.S. to resolve that. So we are completely dependent on the global system for materials and manufacturing, so on and so forth. So it is an absolute existential requirement for the U.S. to not blow up the global financial system. We need other countries to live. And they're dependent on dollars, and the dollar, uh, whole weaponization thing, yeah, that's of course the case. Check back in 20 years. But the point is, we need other countries, and we can't destroy other countries' fiat. So they're not going to let this thing blow out. This thing blew out with a tweezy top at 113, and the whole world was crying. It was falling apart. Bank of England was blowing out. Gilt market was blowing out. It just so happens England, one, is an ally, and two, it's a large population, and they do a lot of things, and they're very productive, and we need them. Can't go around blowing up other countries' currencies. Unfortunately, there's marginalizable, it's all there's collateral damage in the smaller countries, and Africa takes a brunt of it. There's been a lot of currency failures in Africa. But we're talking about the meat, not at the margins. The margins, you get your failures, but at the meat, the core, the bigger countries, you can't blow up the bigger countries' currencies. So my general expectation is dollar down, and at least in a relatively slow fashion. And I think we've been, look, this chart screams a hell of a story. It's an absolutely remarkable story. We've seen dollar up since 2008. And now they're going to have to do new geopolitical controls and make some fresh levers to manage this, because they know they're putting a shitload of pressure on foreign currencies and allies alike. And everyone's saying, dude, get your shit together at the Fed and the Treasury and stop fucking us over. Manage your damn currency. And yeah, I understand the world opted into this global dollar system because they borrowed everything in dollars. The phrase reserve currency isn't understood. Oh, the reserve currency is going to change. The world chose to take their debt in dollars, and they owe hundreds of trillions of dollars, and you're not changing. There's no opting out of that. You owe hundreds of trillions of dollars. So there's no switch to flip. You got to first pay back your debts, because otherwise someone's going to come knocking on your door, and then you can make different decisions. But as we've explained, nobody pays back their debts. So the global construct needs to expand, and that's what it's going to do. So that's why it's going to get weird this time. It's going to get weird every time, and it's going to get weirder and weirder. And a big reason it gets weird, is because most people don't understand how this thing works, the mechanics that I've described this stream thus far. Interesting mechanics, huh? It kind of really tells a very different story than what circulates on social media about the money printer, where the money printer is literally not the U.S. It's the rest of the world that prints the dollars. Under what conditions tell us the timelines. And our debt construct tells us how big the next dollar expansion is going to be. The next dollar expansion is going to be biblical. It's biblical. $13.9 trillion of money, which is used to print 140 to $600 trillion of currency. That's going to be freaking crazy. So, that has a whole conversation about the implications and the impact, the effects it has on the crypto space, and the choices you could take. Sure, you can make multiples on meme coins and whatnot, but the truth is this space is going to absolutely run multiples at the rational level. The investor, the old man, which I probably fit that category, that looks at the space as business. The businesses are going to run monumental multiples. Anything that's in the millions of dollars of market cap, oh my God, less than 10 mil market cap, oh my God, 100 mil? The 100 mil market caps are going to be 20 bill market caps at some point. The $1 million market caps, sub 10 mil, getting repriced to a bill, to 5 bill, to 10 bill. Broadly, my expectation last cycle, top 100 was in the $1 billion range. I expect this cycle, the top 100, to be in the double-digit $1 billion market cap range. 10x market cap on the top 100, which means the businesses are running 10 to 100x. All of them. All of them. And that just requires patience, and you don't have to run around and lose your money on the gambling bullshit. Just sit back and invest like an adult, inspecting properties and balance sheets and looking at companies for what they are and seeing what's mispriced and why it's mispriced, what's the product and service they offer. Because you're going to get opportunities in the crypto space that are financially impossible in traditional finance, frankly, technologically impossible in traditional finance, and probably regulatorily. It's just you can't do this. The best thing you get is a REIT, which requires the vast majority of income to be passed through. But still, then the business expenses are subjective. You're still subject as an investor to the subjective discretion of the business operators and how they manage the business. So in these crypto markets, you're dealing with financial products. They're not buying shit. There's no human resources. There's no debt. It's just credit, foreign exchange, and derivatives. And these are businesses that you cannot own on the New York Stock Exchange. You cannot own anything that's remotely like these businesses on the NASDAQ. They don't exist. You can't buy a bank in the stock market. When you buy shares of Chase, you are not buying a bank. You don't own shit. Warren Buffett historically said that if you buy shares of a company, you own a company. No. If you buy 30% of the shares of a company, you own a company. When you're Warren Buffett size and you buy those quantities of shares, yes, you get a seat at the table. People listen to you because you own a meaningful percent of the company. When you're a retail investor, you own nothing. You have no voting weight, no voting capacity. Your yields are the subjective discretion of the board, which are the scraps, the table scraps that are left over after OPEX, CAPEX, bonuses, executive pay. And here's a couple of fucking dollars. Please don't sell or dump our stock. And that's what buybacks are. Buybacks are a bribe. Oh, we're going to buy our shit because that's the traditional finance, the equities way of managing their currency supply. Oh, buybacks, buy pressure. Oh, there's QE. It's corporate QE. By definition, buybacks are corporate QE. I mean, buybacks in the crypto space are the same thing. So I'm not fond of the buyback mechanic. I'm fond of just pure cash flow. Get the fuck out of the way and just pay me. And that's the way it used to be. It's the way it used to be, maybe at the best days in the equity markets where you invested based on cash flow and you get compensated for the risk you're taking. But there's nothing like what exists in the crypto markets that was ever available. There's no human resources. There's no real estate. There's no debt in these businesses. It's just pure product, pure service, pure cash flow. It changes everything. All right, I guess that was an introduction. Yams in the house. Good morning. Love the fingernails. Yeah, good picks nowadays. Interesting to hear your thoughts about restaking an eigenlayer. Big stuff. Derivatives. by definition, a derivative product, derivative of an asset that has properties of moneyness. So we could simplify and call it a money. Ethereum has moneyness, therefore it's a type of money. Money has volatility, has FX spreads, so on and so forth. So just respect it for what it is. So these derivatives are very interesting, and the yield is going to flow because there's going to get leverage, and there's going to be risk, and there's going to be explosions, and that's the biggest characteristic of these businesses as compared to traditional credit. Under collateralized credit, the risk is on the institution. Over collateralized credit with sociopathic liquidation engines, the risk is on the debtor. Changes the whole damn equation for who's taking the risk. Absolutely fascinating. iGoLayer is cool. Well, look at what f of x is doing with our ETH. So I like a lot of what f of x is doing. It's a big deal. They have so much voting power that the entire stack is going to be interesting. So the question with regard to Aladdin products is uh, uh, discount versus premium, and uh, and the best bang for the buck, position size, standard portfolio composition, and how does it fit in? So those are the types of conversations and calculations that we have in our mind when we're thinking about where it fits in. And I'll probably end up talking with them on their Discord soon. I like that crew. They're doing very innovative things. They have just so much voting power. It's very interesting. And I think the opportunity is even necessarily with FXN. And I didn't opt for that. I opted for a CTR. And there's probably good opportunity with Cleve as well, and ALD. Now that the tokenomics, 85% of the supply was poof. So that's is pretty interesting. So if you're not going for FXN and you're going for the other products in the ecosystem, that's beta. You're looking for, second order effects where people start to realize, there's other shit in the ecosystem. So check back when the currency supply in the crypto markets goes 10x on the supply and everyone's in a frenzy looking for shit. Maybe actually get bigger multiples with the beta, which makes sense. Would love to gain exposure to that biz as well, trying to understand how. Position size and exposure. I like to think of exposure to markets as a whole because markets have a currency construct from exogenous flows and endogenous currency creation. So a market needs the tooling to make its own currency and also the incentives to encourage and drive exogenous flows. So the markets tell us what's working. And there's obviously the risk component where capital is most comfortable. So the capital is obviously most comfortable on Ethereum mainnet, which is a marginally positive sum environment with $77 billion. Binance Smart Chain, remarkably negative sum environment. Huh. How about that, week over week? But 4.73, yeah, this was over 5. So something may be changing with regard to comfort level on Binance Smart Chain. But Solana has wow, a very large positive sum environment, 8.81% week over week, 2.79 billion. Market speaks, tells you the truth through the bullshit. Arbitrum next up, positive sum environment, $2.6 billion. Polygon and Avalanche down the list. They'll all have their day. Where's Phantom and Andre with his comeback arc is very interesting. Very, very interesting. Anywho, let's keep it going. Daily Noah vibes, good for the soul. Tapsies in the house. A pleasure. Frax proposal, thumbs up, thumbs down, lots of bitching in the Telegram. I don't listen to anyone but myself. I look forward to seeing what plays out. And I am very comfortable and happy with that exposure. Gazika, good morning. Killis, morning. Snoke, lovely. Killis says, yeah, baby Noah. That's my big pretty. That's the big one. Snoke rationality check, taking part, yes indeedy. Blessings. BRICS has been quite anything new in that movement. It's irrelevant. Check back in 20 years for progress. the time frame and timelines for the shit to play out at a macroeconomic level and a nation state level is decades. If you're talking about like the migration of manufacturing from China to Mexico, which is playing out, check back in a decade. All this that shit takes a long time. Snow tape pusher for the TWAP, you use specific moving average, 50-day, or is the TWAP its own thing? Time weighted average price, and there's a variety of different ways to inspect it. I like the MAs, obviously. Look, there's a 200 on the purple, 100 on the blue, 50 on the thick green. You can see the dark green in there. That's the 10 SMA, and obviously the SMAs are relative to the time frame you're looking at. So that's the 10 on the 3 month, and the green that turns red is the time weighted average price. Time weighted average price is a moving average that's kind of like down the middle, at least the way I conceptualize it. You can also do volume weighted average price, but I like time weighted average price, and it's just right down the pipe, average of averages, something like that. It gives you a baseline, a point of reference. Is it at a premium or a discount? Now, not really relevant to this chart in some regards. Good morning, Cap, checking in. Good parts. Snoke, Dan, Brian. Having 600 trillion new circulating dollars might help countries pay off their dollar debts. Do you really think that's going to play out? And it's not new dollars because it's debt. So the dollar is debt. It's credit. So you don't borrow dollars to pay off. Well, actually, you do. You borrow dollars to pay off other dollar debts. And what's that called? Refinancing. But they're going to not be encouraged to refinance because it may be at a higher rate. So they might have to refinance at the higher rate, which means more flows, more cash flow, more yield, and that drives economic activity. So, and incentives. It's an incentive. So it's a very different environment than it was prior to 2019, 2020. So yes, it's a cyclically different environment, but the odds are it's also going to be a secularly different environment. Cyclical is a shorter term time frame, the cycles up and down, and then secular is those ups and downs over time. Like if you have ups and downs, but the trend is higher lows and higher highs, you can see the secular trend and the cyclical along that secular trend. Hope that helps. Tape, does US dollar inflation mean similar euro dollar inflation? Yeah, same phenomena happens with other currencies, but be very specific when you talk about inflation. Currency inflation is not consumer price inflation. It is not asset price inflation. Inflation just means more. Deflation means less. That's very important to understand. It's a misused terminology as used by the general public. It's relative. It's a relative terminology. It's a adverb. Currency maybe is a noun, so I guess but it's the change in the currency. So and that's a verb, so it's an adverb. So yeah, it's applicable to something. It means nothing unto itself. Ooh, inflation is high. Inflation of what? Currency, consumer prices, real estate. It's relative. Okay, so good question. Generally speaking, uh, everyone wants in. So debt is very contagious, and it's either expanding or contracting. So it should be consistent, I would imagine. Albeit there's always outliers, and some countries are in contraction while other currencies are expanding. But generally speaking, the one that means the most is the dollar, because if you're in Europe, yeah, the euro is used a lot, but the dollar is used more. Brent Johnson type of conversation, dollar's everything. That's what everyone wants. That's what everyone uses, not at the margins. That's the core of the system. Hey Cap, have you looked into PenPy, basically convex for Pendle? Been looking into them recently. Well, you need the recyclers, and at, maybe that was an early narrative and observation on my part of the Federation and the recycling and the sterilization and how that compared to nation states historically and the petrodollar, which is perfectly analogous to, and now it worked. It's stabilized curve, and it's doing it very well for other protocols, and everyone wants a recycler. And no, I have not. I have no need to. I don't need any diversification, and it is very hard for me to look into new things. But clearly, we made a lot of purchases. There was Ramses, and I took some Athena, and I don't know what else if I grabbed. A fair amount of buying. Wait, I'm not showing everyone the portfolio. Let's go over here. It's been a fair amount of buying, and that's you got to be considerate of how you structure the portfolio and and use the rules and the best practices that we've discussed over the years. Position size, premium, discount, bang for the buck, XYZ. How much does it cost? How much is it paying? How likely is it to continue to pay? Are you excessively diversified? Are you effectively concentrated? Can you afford diversification? Smaller portfolios can't afford diversification. They need to concentrate more. The smallest of portfolios may not even be able to invest. Bitcoin, Ethereum are not investments. Those are cash. They have moneyness. And you need to respect FX, the cyclicality. Bitcoin at some point will come down. The dollar will appreciate against Bitcoin. When? When the damn move indicator blows out and the global currency supply is going through its cyclical contraction. Less dollars, dollar goes up relative to everything else. The scramble for dollars. At some point, everything and anything that isn't nailed down is sold for dollars. Respect the cyclicality. And you do that with the cash position. Investments are investments. Investments are businesses. Investments are productive. They produce cash flow. XYZ that shit. Small portfolio, can't invest. So you need to play the FX game to build a cash position such that you have at least a decent amount of capital or an adequate or a threshold amount of capital that you can invest. And these are the types of things you need to define. Everyone needs to define their rules and how they manage the portfolio. What is your threshold? How much money makes for a good investment considering how much overall value you have? Cap Thorchain is top 5 in volume on DeFi Llama. Is there anything meaningful there? Absolutely. Thorchain's big deal. Big deal. I like it very much. Here's the kicker. Thorchain, Pendle, X, Y, Z, A, B, C, a million different protocols. What's the APR from an investment standpoint? What's the APR? 30%? 40%? Is that a common denominator? I mean, that's literally like a math term. But the common denominator means if they're all 40%, they're all paying the same APR or similar APR or comparable APR. It's the same investment. It's contributing the same value to your portfolio. Don't excessively diversify into 30% APR. There's an argument for diversifying into 30% APR. Yeah, I know, it's complicated. Exposure to different chains, and exposure to different markets. Now that's meaningful. And these are the types of arguments I have with myself, and I encourage you to argue with yourself as well in a very, not full-on schizophrenic kind of way, but it's going to seem like it because you're literally having an argument with yourself. That's what you need to do. And you're arguing, do I need exposure? Do I want exposure? Is the diversification worth it? I know concentration outperforms, and I may not even need to diversify because I'm about to diversify into 30% when I'm already getting 30%. And I'm just going to have 30%. Now I have to manage shit on 2 different chains, and I have more work to do. So what's the point of diversifying? Oh, there might be a good point to diversify because now I have additional exposure to a different market, which can have more exogenous flows, maybe has better endogenous currency creation, and there's a bigger market. And maybe that position goes 20x on the money, and you get 30% on 20x on the money, and the original position goes 10x on the money, and you get 30% on 10x on the money, so you're going to outperform where you get the 20x. There's the not the risk, but those are the conversations. Exposure. Maybe Binance Smart Chain has issues. There's been a reason I've hesitated the shit out of that chain and why I have a relatively modest position size in Theta. Because I don't trust it at all. But that shit's got $4.7 billion worth of capital, has the most amount of dollars of all the L2s, of everything other than Tron. So I wanted exposure and I didn't want to oversize the position. There's no right way to do this. There's no this is what you do. There's no recipe. All there is the argument, the conversation, and you make the decisions and you measure in hindsight. How do you think about XYZ of DePIN and AI? Big deal. Aleph, Cartesi, big stuff, and whatever, the smaller cap shit. Big stuff. It's big tech. Um, I mean, it's literally what Aleph is. Pay for revenue and there's staking. There's nodes associated with Aleph. Very interesting. Native token also back with, I'm going to build buybacks. I hate buybacks. I hate that shit. It's big stuff. Okay. You know what's bigger? Credit. Credit is the biggest business on the planet. I don't care how big AI gets, credit is bigger. It's the financial system. So AI is big, and you probably get some, cap gain multiples, of course, because general public is very susceptible to prevailing narratives, circulating stories, hype, and hyperbole, and things run. So, but now you're not an investor. Now you're an FX trader, and you're managing the cash position. So at least define what you're doing. So these are my definitions. I define anything that could be sold as basically a cash. I define anything that is paying cash flow and or cannot be sold as an investment. Anything that cannot be sold because of a lock is a purchase, not a position. Investments that can be sold have increased complexity in managing than investments that cannot be sold. So your, 4-month locks, VLCVX, just deposits like an SJO position. That was another one that was acquired, was Joe, an Avalanche. They can be sold. So now I have to think, do I sell it? So I appreciate the purchase versus the position. Anything that can be sold has a cash-like attribute to it. I want to simplify the work I have to do because it's complicated enough, one, to manage it, two, to manage it well. It's hard to imagine dollar scarcity, currency contraction with the scenarios you describe. Well, it cannot contract. If the system contracts, it deflates, and deflation is recursive. It's an implosion. It's a collapse, a cascade. So it cannot, and that's why it expands. So dollars are very scarce, actually, actual dollars. There's very few dollars on the planet. Go figure. That's what everyone yells and screams, but they don't understand. This is the amount of dollars. There's $5.8 trillion on the planet. That's it. That's the total number. Everything else is credit. And Mike Howell talks about like $270 trillion worth of total liquidity. I'm pretty sure he's talking about balance sheet capacity and not necessarily like bank deposits and the overall structure of the Eurodollar market. I'm pretty sure there's more. I think he's referring to more so the capacity to lend. So there's more. There's a lot. There's a lot more than $5.8 trillion on the planet. So this is the destination of contraction. This isn't the collateral that creates the global dollar supply. That's the bonds, U.S. Treasury products, as we talked about at the start of the stream. But these are the real dollars. These are the actual dollars, of which there's not many. It's just an interesting statistic. So you can think of this chart as it goes up as deleveraging. If you digest how dollars currency is made using bonds, money, you can hopefully eventually digest how this going up is a deleveraging of the system. Anytime this goes up, these dollars were printed a long time ago. You don't use these dollars. Nobody uses these damn dollars. You're swiping a credit card. That's bank dollars. It's bank dollars. You use bank money. You don't use actual dollars. So this is the leverage when it goes up. Hope that helps. Uh, Ritari, hey Cap, I'm curious for your view on tokenomics burning mechanism. Burning circle price is relevant. Very much curious of what you mean in practice. Burning circle? Oh, I'm not fond of like because that's capital controls, and that's literally what everyone's talking about with regard to CBDCs. It's literally just like it's buybacks from equities. So burning buybacks, it's manipulating the currency supply and equity buybacks. I'm more interested in sterilization. Like, yeah, you could have an increasing supply currency, let's say 10% inflation, but because of sterilization, third parties that are sucking circulating supply and putting that into permanent savings accounts for governance rights, and the net inflation is 1%. Net inflation is 2% on circulating supply. Or maybe the net inflation is not inflationary, it's actually deflationary, and you have minus 1% on circulating supply year over year. So, you're talking about supply of currency, uh, supply of tokens, which have these currency characteristics, to be very specific. So that's big deal. And almost every protocol out there has disinflationary emissions coupled with the sterilization really is going to produce net deflation at some point because of the recyclers, because the recyclers have their own incentive systems and their own tokenomics and money flow, money supply, and so on and so forth. Look at convex and curve, perfect example. How much inflation did convex take out of the curve emissions? It neutered it. And then you take the other 20 protocols that are sucking curve out of circulating supply, there's basically no inflationary pressure on curve. You could look into it and see increase in circulating supply, not increase in supply, not quite gecko perspective, increase in circulating supply. Big difference. Cap, can you please talk about Athena and your bull case for it? Yeah, broadly speaking, exposure to market, exposure to Binance Smart Chain. I didn't have exposure to it. I still don't have exposure to base or really optimism in any interesting kind of way. I can't stomach the appreciation of Arrow and Velodrome. Just something feels off about this price action. I mean, and like diversification into the same amount of APR. If you have 40, 50, 60, or 70, 80% APR on that, there's plenty of places you get in that APR. So do I really want to diversify into optimism just for the sake of diversifying into optimism? Meanwhile, base is optimism, except it's the Coinbase narrative. And frankly, Fractal is also optimism, but it has the whole Frax and entire vertical associated with a currency system. So it has much more interesting uh, capacity to express the optimistic narrative. So optimism broadly is not too interesting. I'm happy for the folks at Velodrome because Aerodrome is Velodrome, so they found much more success on base, which is great. Um, so I kind of wanted exposure to Binance Smart Chain. Uh, Historically, I shied away from it. It was uncomfortable. Binance, but I think they're heading into a very institutional direction, which is ends up being very aligned with nation states. They all are. Think about all the big boys. Fidelity is basically embedded in government. So, all right, Binance. So that's its destination. So they have their own network. Okay, so I took a nominal exposure to it. It's the same thing. It's paying what 70, 80% of the money. I mean, that's what Ramsey's is paying. That's what they're all paying. Well, that's what Aerodrome's paying. That's what Velodrome's paying. Um, and that was my sentiment in that regard. So you have to think, is diversification worth it? Do you want exposure to that network? And that was my thought process. Most importantly, do you have the extra capital? And I had the capital and I wanted exposure to BSC. I didn't have any exposure to BSC. I literally have exposure to basically every major market in these emerging markets, other than base and optimism, but that's the super chain type of story, of which I do have exposure vis-a-vis Fractal. But I'm actually thinking which is more meaningful, optimistic superchain versus something like an Arbitrum, because that's kind of speaking. Why does base and optimism only have 522 mil, 733 mil versus Arbitrum at 2.6 bill? So you have to look for the data to find confluence to support what you're thinking. And the market is saying dollars are more comfortable on Arbitrum. And that's interesting. You can't dismiss it. Maybe it's wrong, but it's real. And it's interesting. So I see more opportunity on Arbitrum as compared to the optimistic chains, even considering, look, sure, I wish I had a aerodrome position and I spotted a 2 mil market cap, but that's kind of what you got on Thana and Ramses on Arbitrum. I mean, literally talking about like 2 to 10 mil market cap on those assets, and look what happened with a little bit of economic frenzy on base with a micro cash depth at 627. Jesus. Okay. Maybe it's maybe the narrative changes because that is a massive increase in currency supply. This was about at 3 to 400 mil, up 90% week over week. That's crazy. So maybe things change. You'll be right until you're shown to be wrong based on data, and the data will tell you whether you continue to be right over time. That's crazy. But I still can't justify an aerodrome position. It's at 300 mil market cap. All right, fine. I'm talking about things in the top 100 going to double digit billions. So 300 mil goes 100x on the money to what, 30 bill? No. It goes 10x on the money to 3 billion. You see, I don't know. The number, I need exposure to it. That's where I've settled in my thought process. I don't need exposure to it. And I wish I had exposure when it was priced cheaper. Getting it at a discount, and that's what I have. Everything in the portfolio is at a relative discount or a price that is not at a premium or a premium where I see things heading, but at a price that I could digest as a relative discount. I mean, literally, Ramses was at a mil market cap. That's mispriced. Ramses is a solid exchange where Velodrome's trading at what 60 mil market cap or whatever the hell it's at, and Aerodrome's trading at 300 mil market cap, and this shit on Arbitrum with more 2.7 billion dollars worth of 2.6 billion dollars worth of dollars. Liquidity depth is trading at a mil market cap. Oh, so you look for these types of things that are potentially mispriced. Guess what? The mispriced things, you can apply less capital. A small position turns into a big position, changes the composition of the portfolio. If Aerodrome's sitting at 2 mil market cap and you throw in 10 grand, you're not going to be able to, and now it's at 300 mil market cap, you're not throwing in 10 grand. You got to throw in 100x appreciation. So you're throwing in $1 million. So you can throw around small clips of capital if you inspect something to be potentially mispriced. All right, and the cap on a Friday, the most classic of streams. It is on a Friday. Hope that helps, Dan. Good question. Can you compare the different curve wrappers at some point? How does one decide which to actually choose? Not an easy thought experiment. They all do something very similar. They're competitive products. They're competitive businesses. Staked out versus convex versus what have you. How do you choose? Excess diversification. Do you need diversification with regard to wrapper? Maybe it's just subjective and just choose one versus the other. Staked out obviously has its own tokenomics, so you can boost. There's no real boost from a convex perspective, but it has inherent boost. So two different business strategies on their part and how they constructed the protocols. Um, but the laundry list goes on. You have ASDCRV on concentrator, which is literally a derivative. Can sit in your cash position. So that's interesting. I don't know how to choose that shit. What do I do is I just avoid that, and I understand that those systems attract activity and attract capital and support the core of the protocol. So I sit comfortably at the base layer knowing all the shit's going on that's supporting the business, and and that's where I want to be. I want to be at the center of the action at the base because everything that they're doing is going to support the cash flow at the base of the protocol. Hope that helps. Especially the auto compounders version convince smaller users. Yes, you need, if the smaller the portfolio, if you're interested in cash flow, needs to be auto compounding. You're not going to be able to execute on Ethereum mainnet in any effective way unless it's auto compounding. So you're talking about the Union, you're talking about Aladdin DAO concentrator, you're talking about what the wrappers, CDX, CRV, but now there's volatility, relative pricing volatility of those assets. They're not pegged assets in any regard, but the wrappers are interesting. But I don't expect significant appreciation for CRV. And that's got to be the most contrarian realization that most people see that I have. Why would I own something if I don't expect it to asymmetrically appreciate and go up a bajillion frickin' percent on the money? Because I have different expectations. Set your damn expectations. Define your expectations. And please make sure your expectations are reasonable and rational. And that way you can actually achieve your expectations. The most important thing about your expectations is that you actually achieve them. You don't want to be disappointed. You don't want to have completely wrong expectations because you're dropping the ball. Do yourself some service and show yourself some respect and set reasonable expectations because uh, under under promise, over deliver. Classic dev terminology. So set your expectations low, and if you surpass them, it's exciting. You make good choices. You make good decisions. Well, to hold VCRV, probably better for sure, but for big holders, VCRV's big holder. Um, VLCVX is considerable, but which outperforms more, curve versus convex? I know Tetra to say convex, and I lean to probably agreeing. But now you're considering 4 month lock versus 4 year lock. I have a moneyness to the position because you can liquidate it. That sure changes the equation in 2025 when interest rates are getting cut and move is blowing out to 120. You can sell it. You kind of should sell it. So there's going to be increasing volatility associated with it because of that. It's a position. It's not a purchase if it can't be sold. So I think this influences composition of the portfolio and reasons why to choose one thing versus another. And for the cash flow, and I appreciate that, and I know the vast majority of this space is not an investor, and they don't want to think like this. They want the 10,000% returns and all that insanity. And you're in it for the cash flow, Ida, and I appreciate that because that's what I am, and I'm willing to take time. I like time, and if I was 20 and right now, great, check back in 10 years. Frankly, I'm 40 and I say check back in 10 years. It's okay. It's okay for things to take time. It's okay to not be greedy. It's okay to try and not gamble. To not have it's okay to have reasonable expectations. It's okay to be rational. It's okay to be an adult. Um, what amount of mining from which you go directly to V curve and not wrappers? It's subjective. Everyone will have a different threshold. That's geopolitically sensitive. It changes if you're in South America, Africa, Southeast Asia. How much do you need? What are rents? What are housing prices? What are your expectations for renting versus buying? Maybe you just want to rent. Maybe you got 5 people you're living with and your rent is $200 a month and you can generate $200 a month in income from a position. It's all relative, and that's why it's so hard to manage capital. Snoke, a pleasure. Idan, you're very welcome. True, so much of investing is personal growth, and it's just you learning who you are and what you want to be and how you want to live. And the most important thing about investing is you got to be cool as a cucumber. You got to be smooth. And that's why I'm comfortable because I understand why the global currency system is going to do what it's going to do. And I understand the global money and how money makes currency, and I see it in the data where things are heading. That brings me comfort. The most important thing as an investor is to be comfortable. Um, Become a grown up. These are important things. Good stuff. Good stuff. Okay, okay. It was a good stream today. Good Friday. I may take off Monday, but I appreciate all of you. 12:22 p.m. on a Friday, March 22nd. In the description on YouTube is Discord, the most rational community in the entire crypto space. I'm still working out the kinks on crypto payments for Discord. I want to support Solana. I certainly want to support Arbitrum. I certainly want to create Cap Token, which could be used to pay for Discord or maybe one-on-one sessions as the market continues to get hot. But I think I have a capacity to create a payment system, my own payment system. Why not? And which gets interesting considering the voting weight that I have. I think that I could throw around some interesting APRs on Ramses and frankly on mainnet, but mainnet's expensive, so I stick to the L2s. And bridging is complicated, so I may not go cross chains and stick to Arbitrum, which has the most amount of dollars in the entire L2 space other than Binance Smart Chain. So I think that would be interesting, seeing 1,000% on Cap Token, and Cap Token can be used to pay for one-on-one sessions with myself or pay for Discord subscriptions. So I think I wish to get those puzzle pieces and working. I think that'd be fun and interesting. Tapioca getting ready to launch, James. That's right. I very much look forward to Tapioca. It's been quite the delay, but whatever, time is like that, and we'll see what it does. I certainly am looking forward to its launch. Iden, yeah, it does sound, no seed. There's no capital raise, there's no offering, no nothing. This would be a very rational presentation that will happen to throw around 1,000% APR on Ramses. Anywho, I wish you all a good weekend. Stay rational, and I will see you next week. Peace.